Picture this, the unstoppable AI boom, the one that completely dominated the markets, suddenly just stops. In early 2026, that's pretty much what happened. The high-flying AI rally hit a brick wall, and investors, well, they scrambled for the exits, trading their tech stocks for something a whole lot more tangible. So let's break down exactly what went on. And traders, they love to coin a phrase for moments like this. In the heat of all that chaos, they came up with the perfect term, the SaaS apocalypse. It really gets at the sudden, almost existential threat that these new autonomous AI agents pose to the entire software-as-a-service industry. So, what was the price tag on this so-called SaaS apocalypse? A jaw-dropping $300 billion. That's the amount of market value the software sector just evaporated in a single day on February 4th, 2026. This wasn't just a bad Tuesday. This was a shockwave that forced everyone on Wall Street to completely rethink the game. So how in the world did we get here? And what does this all mean for the future of tech? Well, here's our game plan. We're going to start by digging into the SaaS apocalypse itself. Then we'll follow the money and see where it all went. We'll unpack why the AI boom hit a wall, identify the really surprising winners and losers, and explore this huge shift from digital pixels to physical power grids. And finally, we'll ask the big one. Is this a whole new era for AI? Okay, let's start with the day the ground literally shifted under Silicon Valley's feet. A sell-off so intense it got its own disaster movie nickname. This timeline really shows you just how fast everything unraveled. It kicked off in early February when tech companies reported they were spending just massive amounts on AI, but the returns, kind of disappointing. Then boom, February 4th hits and real panic sets in as it looked like these new AI agents could just build the software we all pay for. By the middle of the month, you could see a full-blown stampede into safer, old-school sectors, all with these tough new AI regulations from the EU looming on the horizon. So, that tech sell-off was the spark. But the real story, the bigger picture, is where all that cash ended up next. And that, my friends, is the great market rotation. Now, analysts call this a classic market rotation. It's a fancy term, but the idea is simple. It's basically a massive rerouting of billions and billions of dollars as investors all at once change their minds about what the future looks like. And in this case, the shift couldn't have been clearer. Away from risky, high-growth tech and straight towards the safety of companies that make the stuff we use every single day. And the numbers here, they just paint a crystal clear picture. You can see the tech sector just stumbling, down over 3% for the year. But meanwhile, the quote-unquote boring sectors, we're talking companies that provide your electricity and your toothpaste, they suddenly became the market darlings. Utilities saw a nice, steady gain, while consumer staples just shot up an incredible 13%. Which, of course, leads us to the million-dollar question. After years of just total, nonstop dominance, what on earth slammed the brakes on big tech? It really felt like investors just collectively hit pause on that whole AI at any price era. And it wasn't just one thing, it was a powerful combination of headwinds hitting all at once. So first off, investors got what you might call CapEx fatigue. They just got tired of seeing these companies spend billions and billions on data centers without a clear payoff. Second, inflation was being stubborn, which meant interest rates weren't coming down anytime soon, and that's always bad news for growth stocks. Then you pile on new regulatory hurdles coming out of both Europe and the US, plus renewed threats of trade tariffs, and well, you've got yourself a perfect storm. Yeah, whenever you have a massive shift like this, you're going to have very clear winners and very clear losers. A whole new pecking order started to emerge in the market. And the contrast here is just so stark. On one side, you have the fallen darlings, the tech giants like Microsoft and IBM, suddenly facing some really tough questions. And on the other side, the unlikely heroes, rock-solid power companies and timeless brands like Coca-Cola and Colgate-Palmolive. And if you really want to grasp the scale of this whole thing, just look at this number, $1 trillion. That's trillion with a T. That's roughly how much value Microsoft's stock shed from its peak, all because investors started asking if the colossal cost of its AI ambitions was really worth it. So at the exact same time these tech giants were bleeding value, a classic forever stock like Colgate-Palmolive, a company people rely on whether the economy is good or bad, was surging. It was the perfect symbol of this flight to safety, where good old predictable earnings suddenly became the hottest thing on the market. This whole rotation, it signals something much deeper than just stock prices. It's about a fundamental shift in how we think about the entire AI boom itself. It's a move from the abstract world of pixels to the very real world of power grids. See, for years, the market was completely obsessed with the AI brain. The models, the software, the clever programs. But in 2026, the focus just dramatically flipped to the body, all the massive physical stuff you need to actually power it. We're talking about raw electricity, hardware, power grids, and pipes. What this all boils down to is a massive reality check. The market is waking up to a simple truth. The most brilliant software in the world is totally useless if you don't have a reliable power grid and the physical hardware to run it on. The story isn't about growth at any cost anymore. Now it's about structural accountability. Investors want to see the real, tangible assets that hold up this whole digital revolution. And that brings us to the big question that everyone's asking now. What does this all mean for the future? Is this just a temporary correction, a little blip on the radar, or are we looking at a fundamental long-term change in how we value technology itself? And this right here, this is the provocative question that really captures the new reality. The game is changing. It seems the question is no longer about who can build the smartest AI, but who has the raw power to actually keep the lights on while it runs. The focus is shifting from code to concrete, from pixels to power plants. Thanks for joining us for this explainer.